Hi, I'm Kevin Knaus with InsureMeKevin.com, and congratulations on the new job. And you have to report that income to Covered California. And as you've probably noticed or suspect, it's going to decrease the subsidy that you're going to receive. And for some people, it makes a really big difference. It really drops down big time. So let's go through an example as to why this is happening. So Joe and Jan, when they applied to Covered California for a January 1 start date, they had an estimated income of $25,000. And going through the IRS calculations, because that's what Covered California uses, it determined that they were eligible for a premium tax credit of $14,400 for the year. So when they did their taxes at $25,000, they would have this $14,400 tax credit. What Covered California does is they take that annual tax credit and they chop it up into 12 equal increments, and that comes out to $1,200 a month. And then they take that $1,200 and they forward it to the health insurance company to reduce Joe and Jan's health insurance premium, which is great. And if they have $25,000 of income when they do their taxes, it's a wash. They neither owe any money back and they get no additional credit. Unfortunately, Jan picks up a job in the middle of the year and the income bumps up quite a bit to $55,000 a year. So they kind of look at the shop and compare tool, and at that amount, that is an annual tax credit of $10,200. So quite a bit less, but still it comes out to about $850 per month. So, okay, well, they can do that. That's just, about $300 or $400 less. So they go in and they then increase their income in Covered California, and the subsidy is much lower than what that shop and compare tool said that they were going to get. And what's going on is that in the first half of the year, because they made the change in June to affect the July premium, for the first 6 months of the year, they were receiving $1,200 per month in a subsidy. Okay, so that's out the door. You cannot claw that back. It is done with. So they have already been forwarded by Covered California $7,200 in a premium tax credit. So, but now with the higher income of $55,000, they're only eligible for $10,200, and we have to subtract the $7,200 that they've already received. That leaves them only with a remainder of $3,000 to be extended through the year. So Covered California takes that $3,000 and chops it up into 6 increments for the remainder of the year, which comes out to $500 per month. So their subsidy drops big time from $1,200 to $500, and their health insurance premiums go up quite a bit. And that is all to make sure what Covered California is doing is that Joe and Jan don't receive too much premium tax credit, because if they had not changed their income, they would receive the $14,000, but they have a higher income when they do their taxes, and they would have to pay some of that premium tax credit back. So that's kind of the weird mechanisms that are going on, so that if you do an increase change in the middle of the year, you will see a much larger corresponding reduction in your subsidy if you had been receiving subsidies at a much lower income amount. So it's just kind of the hard facts of life. Now, the reverse also happens. If in the middle of the year your income goes down, then you will see a much larger corresponding increase in the subsidy, which is nice. But if you're on the other side where you have the good fortune of getting a new job or getting an increase in pay or new contracts, then it can really kick you in the rear end when the subsidies are recalculated through Covered California. Hopefully that explains some of it. If you have any questions, you can leave comments down below, and or feel free to reach out to me at kevin@insuremekevin.com. Thank you so much.